Good morning, everybody, and welcome to the third in this series of IMAP webinars. It's our review of where we've arrived at on exactly the midpoint of the year, the last day of the financial year. So it's an opportunity to look at the performance we've experienced to date and the outcomes that investors have received in the 6 months or so to the 30th of June, but more importantly, an outlook for the next 6 months and the next 12 months. So the third in this webinar series. We looked on Monday at the equity classes. We looked on Wednesday at fixed interest and the outlook for interest rates. And today we're going to be looking at the hard assets, real assets and listed infrastructure with Shane Hurst from ClearBridge and Mary Power from JANA. It'll be my pleasure in a moment to hand over to Brad Creighton, the moderator for this week's series. But before I do hand over to Brad, let me just say a little about upcoming events that IMAP's involved in and providing. We've been undertaking a study over the last month or so into the high net worth segment and the role, if any, that managed accounts play in that. We've spoken with a number of leading organisations for whom this part of the market is a key segment on which they focus. And the outcome of that is a webinar series, which we ran last week, a study document, a guide, which we're in the process of putting together, and then a masterclass to be held in association with our Advice in Action conference in about 3 weeks' time in Melbourne and in Sydney. We'll be joined in that masterclass by leading providers of services to this segment. So Matthew Swakonic from Findex will be talking about structuring to serve this market. Michael Karagianis from JANA, Mary's colleague, will be talking about serving the family office market. James Trude and Martin Crabb from Climb and Shores will be talking about the issue of whether the investing needs of this market are different from the standard mass market advisor market. And we'll be joined by Andrew Tracy from JB Weir, who will be talking about managing the compromise between high service and high efficiency, the use of managed accounts in this market based on JB Weir's experience. As a masterclass, it'll be interactive. And if this is a segment that's of interest or importance to you, I'd encourage you to join us in that masterclass. It follows the Advice in Action conferences each day. So in Melbourne on the 18th and in Sydney on the 20th, the Advice in Action conference will run from breakfast to lunchtime. We know that for many advisors, leaving the office for a whole day is something they find difficult. And so we've restructured our conference so that it commences at breakfast, finishes at lunchtime, and gives those advisors who aren't staying on for the masterclass the opportunity to return to the office after 1. And then, of course, a quick update on independent thought, our conference series in September, where we showcase the thinking of portfolio managers who are responsible for putting together managed account portfolios. So here are the topics we'll be covering at Advice in Action. Its theme overall is building sustainable business models for advice. We find ourselves now in a quality of advice review world where for many retail investors, advice is going to be presented as being free and good. And so thinking through the issues of a strategic plan that leads to a sustainable business model for advice is something that's taxing the minds of many advisors, many practice principals right now. And we'll be addressing some of the key strategic challenges that advice groups face in our Advice in Action conference. The speakers and presenters are primarily advisors. They're primarily people for whom these issues are part of their day-to-day thinking. And I'd encourage you to join us to have an opportunity to share with your colleagues the sort of thinking that they have in terms of building sustainable business models. Now, I needn't tell you how to ask a question, but what I would encourage you to do is through today's session is to use the question button and feedback your thoughts and your questions to our presenters. So now it's my pleasure to hand over to Brad Creighton from AMP North. Brad's been the moderator for the whole of this week. And Brad, thank you very much for the work that you've done. Over to you.
Pleasure, Toby. Thank you very much. Hi, everyone. I'm proud to be representing AMP and the North platform as your moderator today. I'm going to speak for about 5 minutes, summarising the previous sessions we've had, and then introduce the exceptional guests we have for you today. We've had 2 very insightful sessions already this week. On Monday, we heard from 2 equity portfolio managers, Monik Kotecha from InSync Funds Management and Hamish Tadgell from SG Hiscock. Monik and Hamish outlined their approaches to equity investing, which relied upon longer-term secular themes or mega trends. These included digitisation, the contactless economy, the emerging middle class, decarbonisation, and personal health and well-being, among others. The key takeaway was encapsulated by Monik, who said, so long as equity investors continue to focus on the macro picture, there will always be opportunities in individual stocks. Overall, Monik and Hamish are expecting more challenging second half of 2023, where stocks like Nvidia, which led the charge in the first half, will find it hard to push on given current valuations. On Wednesday, we heard from 2 fixed income experts, Jonathan Costello from Western Asset and Alex Cousley from Russell Investments. We covered a lot of ground on macroeconomics, inflation and geopolitics. Jono and Alex both expressed concern for the US economy over the second half of 2023 and into 2024, owing to higher interest rates and overall tighter financial conditions. While Australia is theoretically more sensitive to higher interest rates than the US, owing to its higher share of variable mortgage holders, our presenters agreed that higher terms of trade and a productivity boost from immigration should see Australia fare better. In addition, if the RBA does cut interest rates, Australian businesses and homeowners will feel that relief quicker than many global counterparts, they said. Fixed income is generally looking a lot more attractive as an asset class versus prior years, Australian and US government bonds yielding around 4%, and the spread to equity earnings yields being at the narrowest margin since the GFC. Jono and Alex also said that base case inflation globally is set to fall over the coming years. So with or without a recession, fixed income portfolios stand to benefit from some capital gains, as well as receiving decent coupon yields. And finally, we've come to property and infrastructure, the final major pieces of the diversified portfolio jigsaw. Now, property in particular has come in for some negative treatment among the research houses and media in 2023. Office property in certain pockets of the world, notably Manhattan and Silicon Valley, have been hit by a triple whammy of the shift to work from home, higher refinancing costs, and a slowing economy, which tends to see a pullback in leasing demand. Locally, the Australian Financial Review published an article a few weeks ago citing A-grade Sydney office buildings, one being sold by Dexus in particular at a 17% discount to book value. So I look forward to hearing from our expert with first-hand knowledge of the property market and infrastructure too, which is an increasingly diverse and evolving asset class. Both types of assets have some very appealing portfolio characteristics, chiefly inflation protection and a lower volatility and correlation versus the other major asset classes. So on the infrastructure side, we have Shane Hurst. Shane is a managing director and portfolio manager at ClearBridge. Shane has 23 years of experience, including stints at Hastings Funds Management, Tribeca, and AMP Capital. He is currently the portfolio manager for ClearBridge's global infrastructure strategies. And on the property side, we have Mary Power. Mary is the head of property research at JANA Investment Advisors. She covers domestic and global property across both listed and unlisted markets. Mary has been involved in a number of direct property and take private deals in Australia, parts of Asia, the US and London, and she holds positions on various investment review committees, including Charter Hall, Lendlease, Dexus, and formerly AMP Capital. Welcome to you both. And Shane, I'll now hand over to you.
Thank you, Brad, and thank you for that very kind introduction. And clearly, thank you everyone for joining me here today. So the title of the presentation really is how to deliver investors comfort through infrastructure's clear resilience. And the way we think about it is really your definition of infrastructure. So how do you define infrastructure? For us to deliver those very stable risk-adjusted returns and that stable and growing dividend profile that we aim to achieve, we think about it in two ways. Firstly, regulated and contracted utilities are part of our definition. These tend to have a regulated asset base, regulated return. As was mentioned by Brad, they are able to pass through inflation. They would include assets like water, electric, gas, and renewable assets. They tend to be the more defensive end of infrastructure, and certainly for strategies like our income strategy are a much larger component than the transport infrastructure names. When you think about user pay assets, which are also within our definition, these tend to be your airports, your roads, your rail assets, your communication assets. They're more concession-based, contract-based, and certainly more have a tilt towards GDP exposure. And so they're our core areas of definition. Where we don't include assets or where we exclude assets from our definition, these really are your illiquid assets, your more volatile cash flow assets. They tend to be commodity sensitive assets, anything that won't deliver a very stable risk return outcome. For us, we will exclude from our definition of infrastructure. So why listed infrastructure? And there are a number of core reasons why you should own listed infrastructure. The first is diversification, so a low correlation to most other major asset classes, very attractive upside and downside beta, and we'll look at that on the next slide. Clear inflation hedged, so the ability to pass through in inflation, stable cash flows and stable dividends with that very stable risk-adjusted return profile. And as we'll go through in the rest of the presentation, significant growth drivers, which are structural and will lead to 10, 20, 30 years of structural growth for the asset class. So when we look at this slide it really tells you two things. So if you look at the bar chart on the left-hand side, what it shows is the asset class itself has very, very strong underlying structural growth. And that's that kind of green line there, kind of merging into a dotted blue line. What that shows is the asset class itself grows at anywhere from 5 to 7% per annum and is expected to grow at a similar level over the next 10, 20, 30 years. If you go back 20, 30 years ago, this growth was more like 1 to 2%, right? So really, really crucial, because when people compare infrastructure and utilities to bonds and talk about them as a bond proxy, what's really, really important to differentiate is the underlying growth of the asset class. And you can see on this chart, that is likely to be in the 5 to 7% per annum range. That is very much followed by very, very strong cash flow and also very, very strong dividend growth on the back of it. As you can see on the right-hand side, the beta chart, what that shows is our income strategy compared to global equities. And what's really clear here is the asymmetry. That is, if you think about a market that moves up, so a 1% increase in the market, Our strategy tends to move up about 0.65% of the time, so a 0.65 beta. But importantly, the downside beta is 0.39, i.e. when the market falls 1%, the strategy itself would only fall 0.39%. Why is that important? Well, clearly it's important because if you can preserve capital in down markets, then when markets run and markets outperform in general, we can continue to compound that strong performance, that strong growth going forward. So a really key characteristic of the asset class, and certainly a key characteristic of our portfolios. So when you think about some of the key themes and opportunities ahead, and we'll spend a little bit of time talking about these now, there's no bigger theme than decarbonisation. So decarbonisation, $36 trillion expected to be spent on clean energy over the next 25 years to get anywhere near a net zero outcome. How do we benefit from that? Clearly through our clean energy exposures, our contracted renewables, also through our regulated and contracted utilities as they strengthen grids and decarbonise, but also through our pipeline exposures as they start to move hydrogen and they start to take account of carbon capture and storage. So that's a very strong theme, and we'll certainly talk about that on the next slide. Fracturing of global economies is another prevalent theme. What is this? It's really the just in case rather than just in time, the shortening of supply chains that we've seen post-COVID, but also we've seen as a result of the Inflation Reduction Act being passed in the US and similar acts around the world. What does that mean? Well, it's really meant far more domestic manufacturing and far more incentives to do that. And as we'll talk about in a moment, that certainly has benefited infrastructure and utility assets. We've talked about the uniqueness of the inflation hedge, with our portfolios passing through over 90% of inflation. 5G evolution, so really the thirst for demand for data, that's also a big positive. And then finally, a big theme we are seeing is the listed-unlisted divide, and that is with $300+ billion sitting out there in capital, in dry powder, waiting to invest in listed markets, we have seen assets, part assets, or entire companies acquired at 30 to 40% premium to where they're currently trading. What does that say? Well, it says a number of things. Firstly, it says listed infrastructure, by and large, core listed infrastructure is very attractive and is attractively priced. But it also says our companies are able to fund their growth going forward by selling assets at a lower cost of capital than if they would have issued equity or issued debt in capital markets. So, really important to their growth and achieving their growth drivers and their growth objectives going forward. So let's dive into some of the details here on decarbonisation. So this chart looks at what needs to be achieved by 2030 in order to be on track for a net zero outcome. And probably what I'll highlight first is that power sector spending. So currently $0.8 trillion is spent per annum on poles and wires. So basically your transmission and distribution networks is spent on renewables, but then it's also spent on other areas. We expect that to increase to almost $2.5 trillion per annum. How will that occur? Well, if you look at that area on the right-hand side there, wind and solar capacity is expected to go up 550%. So a massive increase in the production of wind and solar and the deployment of wind and solar, as well as other renewable assets. We all know what's happening in transportation. Obviously, electric vehicles are increasing in their penetration. Currently sit at anywhere from kind of 10 to 25% of all car sales globally. That will increase to 60% expected over the next 7 or 8 years. What does that mean? Well, it means you need the grid capability to actually move electricity backwards and forwards to facilitate more electric cars being plugged in at your homes. And currently that infrastructure does not actually exist. So that is a huge amount of capital, $16, $17 trillion just to do that globally. So, massive amounts of spend. We are also seeing changing behaviours. Places like France, flights less than an hour have been outlawed. So you have to catch train or in fact drive, and that's continued changing of behaviour. And then finally, buildings, certainly in places like California and other places of the US, have been told that any new building really can't be fitted with gas, and in fact has to be electrified, often with solar panels or some other type of renewable generation fitted to that building. So, massive theme, massive driver for our sector, and certainly, as we'll see in a moment, is expected to contribute very, very strongly to growth going forward. Fracturing of global economies, we briefly mentioned this before, but certainly what we have seen since the Inflation Reduction Act is greater amounts of investment expected and occurring in places like the US. You can see on this chart, 20 new clean energy manufacturing facilities have been announced for the US. $270 billion in additional investment is expected just as a result of the Inflation Reduction Act, and really as a result of the fact that countries are now moving their supply chains from places like China and Asia to more domestically sourced to areas which are much, much closer to home, like Mexico in the case of the US. But importantly, what's happened around the world is as the US has announced the Inflation Reduction Act, other countries around the world, other areas like Europe and the UK, have taken that opportunity to really try to wrestle that back. So they've announced their own incentives for manufacturing in their regions. And so this war has kind of begun in terms of attracting capital and investment offshore. And what that's meant for us is certainly greater benefits for utilities as they spend more capital around these manufacturing facilities. Great demand for electricity, clearly, and also logistical benefits. So, our transport names clearly have to build logistical networks around this new manufacturing regime. So, I mentioned about data growth being really explosive. Certainly, we've seen in the US recently over $80 billion on new capacity spend. For us, how we access it is through our towers. Our towers themselves have 25-year take-or-pay agreements. They're able to pass through inflation. These agreements are with your carriers, your AT&Ts, your Verizons, who will pay certain amounts of capital on a very stable contract in order to put their 5G equipment on these towers. Now, clearly, that has been a structural growth driver. Every time we move through a different technology cycle, that continues to drive growth through these assets. And currently, if you look at the amount of demand, you can see there it's expected to quadruple from 2021 to 2025 in terms of data demand usage. So again, a massive, massive trend and a massive, massive structural driver for the space. So this chart's great because it really looks at our IRR. Our IRRs are forward-looking. Clearly, the IRR comes out of our modelling, and what it shows for the income strategy, and we'll use that as an example, is the current IRR is 12.8%. So what does that mean? Well, that essentially means we would expect 12.8% per annum return going forward over the next 5 years. Now, that clearly doesn't account for taxes, fees, and clearly is no guarantee at all. But what that tells you is out of our models, we expect roughly a 13% return per annum. Now, that is very attractive if you look at history. It tends to have ranged between roughly 8.5% to 15%. So 13% is a very attractive level. But when you break it down like we've done in this chart, what you can see is a large chunk of that, 5.2% is actually coming from dividends. So that they're dividends which are roughly 4.95%, but growing at 5% per annum going forward. the 4.6% on top, that purple bar, is really just investment into the existing networks to maintain that business. So you add those two together and you get 4.6 plus 5.2. Clearly that translates through to 9.8%. So you get a 9.8% return without even taking account of forward growth going forward. So that again is a very attractive internal rate of return on equity. You then add in those growth drivers that I've been talking about, decarbonisation, fracturing of global economies, or that thirst for data, and that adds another 3%. So when you add it all back up, we would expect a 12.8% internal rate of return, or return on equity, over the next 5 years, really underpinned by that very strong dividend growth and dividend, as well as fundamental investment into these infrastructure and utilities assets. So look, in conclusion, and just to wrap it all up, there's no doubt definition is critical. Assets need to be regulated. For us, long-term concession contracts, very clear visibility in cash flows and returns and dividends. Essential service assets provide very stable earnings. They are able to pass through inflation, which is absolutely critical, especially in the environment that we're currently in. Public policy is very supportive of these structural growth drivers going forward. Decarbonisation, probably the largest theme, but there are other strong tailwinds, such as fracturing of global economies, the demand for data, as well as that valuation difference between listed and unlisted assets. And then finally, at a 12.8% internal rate of return, underpinned by very strong dividends, underpinned by very strong both organic, structural growth, the infrastructure and utility space, from our perspective, is actually looking very, very attractive now, and with very, very strong growth drivers going forward. So I will pause there and throw back to you, Brad.
Thank you, Shane. That was fantastic. There's a lot to unpack, and I've already got some good questions coming in, but I'll throw to Mary now. Thank you, Mary.
Thanks very much, Brad, and good afternoon, everyone. So look, I've popped together a couple of slides. So I thought it might be good to start with the first slide, which is on the most recent headlines of the sector that is well and truly in the focus for everyone. You can't pick up the Financial Review or many other papers without finding something terrible written about office tower valuations. So whilst I'm not here to defend office, I do think it's worthwhile to perhaps just focus on a couple of points and a couple of that have been made earlier today in discussions. And I think one of them is the US market for office, which is clearly under a lot of pressure. What I'd like to say there, though, is that it has some very key differentials to Australia. The stock in the US market is significantly older than any of the stock that we have here today in Australia. So if you look at stock that's been built since 2000, it is minute, something in the order of 5%. So they're holding a lot of older stock over in the US. And I think that, coupled with COVID, coupled with some issues around security and homelessness and working from home and the commute into the office in the US, which is much longer than most Australian commutes, I think there's quite a lot of pain that's being felt there in the US. In Australia, I'd say we have the sector makes up actually 53% of the index, so it's a very large proportion of the index, of the unlisted index. The headlines there give some pretty large discounts for sales that have occurred: 44 Market Street, 1 Margaret Street, 367 Collins Street, Melbourne, 180 George Street, Sydney. What I would say is that the office market is non-homogeneous. So when you look at evidence of sales, you need to actually peel back some of the metrics to see what it actually means. So, for instance, what the paper wouldn't have detailed about 44 Market Street is in fact it has 26 levels in there, and it has 50 tenants in that building. That is an enormous amount of tenancy, an enormous amount of tenants, and it actually puts quite a stress on the building in terms of its its attributes, its lifts, all sorts of things. And I would say also that it has a very short WALE, which is the weighted average lease expiry in that building, 2.7 years. So the cash flow, to some extent, is impaired very quickly, and valuers would have had to make an adjustment for that in terms of the price that would be paid for those assets. The other point I'd make is, and it's been raised earlier by Shane, is decarbonisation and sustainability. But sustainability, particularly in the property market, is very, very it's a very well credentialed asset class for this. It's got a number of benchmarks that that the property sector is actually benchmarked against, and I would say that single theme is going to bifurcate the office market. So you'll bifurcate it between those assets that are appealing to tenants, newer assets, and some of you might know Quay Quarter Tower in Sydney, state-of-the-art asset, which will be well sought out by tenants in that market, as opposed to perhaps some of these other assets that are displayed here on this slide, which are going to in some cases require a lot of capital expenditure to meet the requirements that are needed under a sustainability lens. And the lens is measured, and everything in property is measured. So the property industry and sector has been on this journey of sustainability for many years. It has a GRESB survey, a neighbours rating, and a wellness metric that buildings are measured against. So in order to actually meet the criteria in those benchmarks, you're going to have to spend a lot of money, or it needs to be a newish building. So we might move on in terms of office and just present there property return summary. Now, it is to the end of May for the unlisted sector, which is the top 4 lines, and to the 23rd of June in terms of the REITs, both the A-REITs and the NA-REIT, which is the global REIT market. And you can see there over 1 year, there's been some fairly, really reasonably unattractive returns there over 1 year. And that's as some of these returns and negative returns have come through, particularly in the office sector. We would expect the office market to be the most impacted. You'll see there that it's probably over 10 years, it's had one of the highest returns, not the highest. Retail, industrial was higher, but you will see that will be impacted, followed by retail, and the least impacted in Australia will be industrial and potentially globally industrial, just given the sheer strength of that market. The REITs have been impacted by higher interest rates, undoubtedly, and we will talk it on the next couple of slides. But the correlation between the A-REIT sector and the unlisted sector is about 0.04, so there's not a very high correlation. Whereas the REITs, the A-REITs correlation to the ASX 300 accumulation index is about 0.8, so quite highly correlated. So when you have things like Silicon Valley Bank debacle, you'll see that fed straight into the REITs. So it has been quite a short-term impact. Just lower down below there on the sectors, I'd like to just talk very briefly about the income return. And again, Shane sort of highlighted that in his return analysis. The thing about property is that income return reliability. They're all, the assets are leased. They have long, generally, reasonably good leases in terms of length, and it's a reoccurring income, so it makes it attractive. After 12 interest rate rises, it's only fair that the cap rates would adjust, and we can see that capital growth adjustment that's started to come through there. There will be more in June. I have, it's preliminary, today is the 30th of June, but, our discussions with managers looks like it could be around -5. So quite substantial, but realistic, given that we've had these interest rate rises. The one thing I would say is that all of the underlying sectors, and we can debate office, perhaps even in question time, and the working from home analysis, all the sectors are reasonably well placed from a demand and supply perspective, and a rental growth rate perspective, so that once the capital adjustment side comes through, we would expect that the new cap rates that will apply to each of the sectors will actually capitalise the recurring income. And the recurring income, in fact, in the leases has got embedded growth in it. And, industrial, retail, property, and office can be, around that order of 3% per annum, which is attractive. Might just move to the next slide if we could. And that's a very busy slide, I'd say, but really what that's just trying to capture is, if you can see the sort of orangey yellow Mercer survey index, which is the unlisted index, it gives a pretty straightish line. So it's a fairly less volatile than I'd say a lot of than the listed side. So you can see the listed side jumps around all over the place, and would we say that it's a good proxy for unlisted? I'd say in the short term, very difficult to say that, given its pricing daily and its high correlation to the equity markets. So equity markets bounce around, the listed will bounce around as well. Over the longer term, some similarities in terms of returns, but you need to be able to just be able to tolerate that volatility. So we like to include unlisted assets, including property and infrastructure, in our diversified portfolios because we like the smoothness of the returns in terms of giving some buffering to equity market volatility. And we see that at times of stress. We might move across to the next slide, please. So just some brief comments about unlisted property characteristics versus listed characteristics, and you can see low levels of volatility for the unlisted. We find very high quality assets with strong sustainability credentials, and there's a focus on total return, income and capital. So we expect going forward that a higher proportion of the total return will be from income, less from the capital growth, but it'll still be there in terms of capital growth. If you think about a normalised return for unlisted property being something in the order of 7 to 8%, we would expect that 5% or so would be income and the rest would be capital. Whereas in the last 12 years with bond rates that have reduced so significantly and interest rates as well, we've seen that there's the capital side of the total return equation has been enormous. So, we have managers in industrial domestically that have produced in the order of 28%, which is really unheard of, and over in the US something like 90%, just off the back of very, very strong rental growth and declining cap rates. The unlisted property market is appraisal based, so by valuers, and again there's been a lot in the papers about the reality of whether the appraisal based valuations are real and appropriate. Having a valuations background, I would say that yes, they are. They're undertaken generally quarterly or 6 monthly. Valuers are registered. They do a lot of there's a lot of work that they do before they can become registered. They must the concept is a willing buyer, willing seller concept. It's been tested in the courts for years. They have PI insurance that they and premiums that they must adhere to, and they have a set of guidelines and regulations that they must undertake. So they look at the whole cash flow of an asset, they look at the age of the asset, they look at the capex of the asset. So they are looking at the asset from many, many angles, and they're also basing that on the most recent sales evidence that's available. In the unlisted market, there's a reasonably high level of information transparency. We sit on at JANA sit on a number of investor representative committees. Managers are very good with information transparency. We can gather information at lots of levels on the assets. There's governance structures there that are robust. They've lived through the GFC. They've adapted through the GFC. They've given a lot of control to investors, which we think is good. The liquidity aspect is that I would say that is not as strong as the listed market, which is obviously you're able to buy and sell on a daily basis. I would say, however, though, a listed asset that is not good is very difficult to move except at a very big discount. The listed market, as I said, requires only a small amount of money to be outlaid, which is very attractive. You can get diversification instantaneously to lots of regions and sectors. Governance is I think diluted compared to the unlisted, where you can have rights issues, etc., which are dilutive. The other aspect is the concentration, particularly in the AREIT sector, where something like the Goodman Group, which is a very good company, industrial company, very good, makes up about a quarter of the index. So as part of that, it's not a pure property company though. There's a huge element of the funds management business, which means that it is subjected to the vagaries of the listed market through its business cycle. So not just a pure rental play, which makes it a little bit more difficult in terms of the volatility aspect. We just move to the next slide, please. And then when we look at what we like to invest in, we place a very strong focus on structural themes that impact real estate. So we like e-commerce and technology. We like industrial. We like demographics and urbanisation. We like housing. Unfortunately, in housing, we've had to go offshore to the US, and we've invested in multifamily, single family, rental housing. We've invested in healthcare. We've invested in life science. So a lot of the sectors that we haven't been able to get here in Australia, we've invested in. And in terms of housing, it's a very broad church. There is, as I said, multifamily, single family rental. There's student accommodation. There's senior housing. There's aged care. So it's a very broad area to be investing in. Sustainability and decarbonisation again, which is a very big area that was raised by Shane. We look at assets that have got high levels of sustainability, very, very important. And also perhaps in other countries that journey through to sustainability and decarbonisation is interesting. Infrastructure has been an interesting play alongside property, providing opportunities everywhere. And I think in terms of globalisation, the issue of geopolitical risk is an issue that we have, been made more aware of as we've, witnessed what's gone on in Russia and Ukraine over the last couple of years. I'd say that Australia, in closing, is a highly desired market from the offshore investor. It's well positioned in Asia Pacific. It's got a very high level of transparency and reliability with its real estate, both at a transactional level and its asset management level. And the other very key aspect, again, which was raised, is the immigration and population growth in Australia that does underpin a lot of the supply dynamics and demand dynamics across our real estate sectors. So thank you, Brad.
Thank you, Mary. Another fantastic presentation. So we've got a lot of questions here to get through. Everyone, we'll get through as many of them as we can. Mary, I'll just want to follow on from your presentation. Is there any difference in the various state CBD commercial property valuations? I'm going to assume that refers to the Australian capital cities.
Well, at a valuation level, they should all be reflective of what's going on in those particular markets. Obviously, the dominant markets are Sydney and Melbourne, and to a lesser extent, Brisbane, Perth, and others. But so yes, I mean, it would be expected that Melbourne and Sydney would be more resilient than some of the other markets. But again, you need to look at that sustainability through that sustainability lens, because it will bifurcate the market in terms of tenant demand. There will be assets that won't be able to meet those credentials, and as organisations, we've all signed corporate responsibility statements, and in those statements, we've actually itemised the neighbours rating of a building that we'll actually occupy. So I think that will play in, and even more so going forward.
Yep, thank you. And I'll just add, because I'm aware of some of the differences in the States. For example, in San Francisco and New York, their property valuations have suffered relative to Texas and Florida. So there's been a lot of relocating to those hubs, and the US has a lot of tax incentives to try and attract certain industries, which supports those areas and different population dynamics. So it is a dynamic. Okay, Shane, we'll go to you. Which companies or subsectors will be beneficiaries of the US Inflation Reduction Act and the European Union's Green Industrial Plan?
Yeah, no, that's actually a really good question. I mean, you think about it, it is a massive opportunity. Mary's talked about it. I mentioned some very large numbers, $36 trillion of clean energy spend. So in terms of which sectors benefit, let's start with utilities, so your gas and electric sectors. When you think about it, electricity currently takes up about 20% of energy usage. That's going to move up to 50% by 2050. I mentioned the 60% sale of cars, electric vehicle sale of cars number. So for us, who will be spending the capital to facilitate that move? And the answer are regulated utilities. Most of the large regulated utilities are listed in markets. So that's one area. Regulated and contracted renewables is another area. Clearly, with almost 5.5 times the amount of wind and solar needing to be built over the next 7 or 8 years to be on track, those companies that we invest in, the long-term contracted companies, will also benefit from that. And then finally, energy infrastructure, so your pipeline companies, whether they be moving oil or gas, will be looking to move cleaner forms of fuel. Hydrogen projects are being piloted and being funded all over the world. I was just in Europe, and an example is all the pipelines being funded all the way through Spain, as well as in Italy. Billions of dollars worth, with backing of the individual countries and the commissions in general. And so they are going to benefit as that capital gets spent, gets wrapped up generally into a regulated asset base, and then we earn a regulated return off that through our investment in these companies. So essential service companies, not leveraged to the business cycle, really will benefit from those structural growth trends.
Thanks, Shane. And I've got a follow-up question. So you mentioned in your presentation growth and investment in future infrastructure of close to US $20 trillion. US GDP today is $25 trillion. So we're talking about creating new economies almost the size of the US over the next 10 years or so. Are there any countries that stand to receive an outsized benefit from all this growth?
Yeah, no, I mean that it is a massive number, and you're absolutely right. Look, I think those countries that really are incentivizing that growth will largely get the outside share. So early movers, let's look at places like Europe. Certainly places like Spain, places like Germany, places like Italy are really trying to incentivize that onshore manufacturing. The US, with the Inflation Reduction Act, we mentioned that $270 billion of additional spend just from that act will get their outside share as well. So, it's the countries that are either a fair distance behind and have very strong policy support, or those countries that really need to incentivize that growth going forward, to actually get to the end point of that decarbonisation trend. So for us, mostly developed markets, obviously emerging markets will play a part in that. I would say just one final thought. If you look at what will likely happen to places like China, countries will rely far less on China for their exports, because they will want to localize those supply chains.
Thanks, Shane. I've also seen a bit of coverage across India with its growing population. It needs a lot of electricity connecting, key infrastructure, and they've got a lot of hydroelectric power from the Ganges, which is an ESG win. So India seems to stack up quite well. Mary, if I could go back to you, please, and you've touched on some of this. Are unlisted property assets appropriately valued in the current market?
If you read the papers, perhaps you may think not. And I think if you concentrate on the listed sector, you may think not. But what I would say is that the professional stance that's taken in undertaking evaluation is one of the highest levels that I've seen in terms of, in terms of professionalism across the sectors. And it's not, the guidelines and requirements undertaking evaluation are very stringent. And as I said earlier, it's court tested. It will go to court if it's challenged. And so evaluate with a mindset like that is very judicious in terms of the undertaking of those assessments. So I would say that they are appropriately valued on the basis that the valuations are based on prior transactions. So they can be slower going down and going up. So they are a point in time. So, not every transaction is available at the 30th of June when the valuation is being undertaken, but all appropriate transactions that have happened will be. So we know Salesforce Tower, for instance, has come off the market. It's been pulled off the market by Ping An. The rumored cap rate was 5%. There's an embedded value. There's an embedded fee in there to payable to lend lease. That's worth about 25 basis points. You bring that back to 475. That hasn't transacted. Valuers will have a look at that, but it hasn't transacted. So if you went to court on your valuation, you could not pull out that as a piece of evidence. You would need to rely on what has happened. So I think yes, they are definitely for the information that is available in the market today when the valuation's undertaken.
Okay, and that might explain why Dexus selling 44 Market Street got some attention, because it was the first major property sale to go through, and now you've got evidence-based transactions, so things might catch down to that.
Yeah, and you having a touch point through a number of office managers, their portfolios have come down probably about -5, just roundabout. So not the -17%. Now they won't have come down 17% because they won't have a WALE of 2.7 years, and they'll have different criteria that will be perhaps more attractive to the market than that particular asset.
Yep, thank you. Okay, Shane, could you please discuss the impact of rising rates on inflation and infrastructure assets?
Yeah, look, obviously very topical over the last couple of years, Brad. I mean, I think the first point to make is inflation gets passed through by regulatory structures, whether it be a weighted average cost of capital or through an adjustment to the asset base. If most of us who have driven down toll roads or flown on planes, it gets adjusted through our tolls or our tariffs. So with that context, that really gets passed through to the ultimate consumer. And as I mentioned, I think earlier in the presentation, over 90% of our portfolio can pass through inflation directly or indirectly. In terms of individual interest rates, what's interesting about regulated utilities and utilities in general, different to property, is that if you think about them, they are essentially monopolies. And so they have regulated asset bases and regulated returns. What that means is at a periodic time frame, whether it be 3 years, 4 years, or 5 years, they get an adjustment of their cost of debt, of their gearing, of their cost of equity, essentially. So they essentially get a weighted average cost of capital adjusted for the current conditions. Now that is very unique to assets and very specific to regulated assets. And as a result of that, as rates move up, they actually get a higher return embedded. And there's a number of examples in our portfolio, whether you're in Europe, the US, or Brazil, where you get that very clean pass-through. And you know, again, that is very unique to regulated assets.
Thank you, Shane. And another one, could you just expand on what you mean by fracturing global economies?
Yes, I saw that question come through. Obviously didn't explain that properly. You know, when you think about global economies, they are very much global at the moment. You know, if you think about what happened during COVID, they broke apart, right? I mean, supply chains, you couldn't source goods from China or Asia or other parts of the world. And so what's happened, and why we term it kind of fracturing of global economies, is countries like the US, regions like Europe, have started to develop their own manufacturing onshore and not relying on the global supply chain that was obviously, you know, heavily implemented back in the 70s and 80s and really was used up to the time of COVID. The reason they've done that is because it's more about surety of supply of goods. They also want to encourage manufacturing, which is absolutely clear. And there's also, as we all know, there are some issues with trading with, especially in the case of the US, trading with areas like China. So, you know, for developed markets, it is going to bring some new structural growth into those markets, and that's clearly going to be a positive for the companies that we invest in.
Thanks, Shane. Yeah, and I think the longer term story is the US had a huge manufacturing hub in the 50s that moved across to Asia, and now we're re-onshoring and friend-shoring and going to Mexico and cheapish places, not as cheap, but getting them closer to home. Thanks. And we might only have time for this last question. Mary, which property sectors are expected to be outperformers going forward?
Yeah, thanks, Brad. So I think looking at our, you know, having done the work on our themes, our structural themes that's in the pack there, I think it's pretty evident that a number of those areas, such as, you know, the, you know, demographics and urbanisation, you know, immediately feeds through to housing. It's a bit hard in Australia to actually work out how to do housing. It's not an institutional sector. It is in the US, and as I said, we've invested heavily offshore. It's in its infancy here in Australia, so it'll be interesting how that actually works. And obviously, the government's got a big initiative in terms of social and affordable housing, and there's build to rent, you know, here, but again in its infancy. So I think the housing sector, I think the ageing population with healthcare, life science, those sorts of sectors, and I think you know, they're going to be sort of really, really important for us, you know, in terms of in the investable universe.
Thanks, Mary. I think that's the time for us today. I've really appreciated it, and to have the quality of experts that we have, yourself, Mary, and Shane this week. It's been a real privilege. Thank you very much. And Toby, I'll hand it back to you.
Thank you very much, Brad and Mary and Shane. And I'd emphasise the point that Brad's just made. I found today's presentation really fascinating in thinking about the role in which these, what used to be esoteric asset classes, are becoming mainstream parts of advisors' portfolios in both the defensive and particularly in the infrastructure area, the growth part of the portfolio. Asset classes that offer potentially 12% return will significantly have a significant part to play in the growth components in the portfolio. So just in wrapping up, let me remind you that the slides are all available, and you'll receive a link to them. The webinar itself will be available through our YouTube channel. And a reminder of the upcoming work that IMAP is doing, the high net worth study leading through to the masterclass in July, and then Advice and Action Conference in Melbourne, Sydney and Brisbane in July, associated with that high net worth masterclass. And here are the topics for Advice and Action. So thank you very much for joining us today. It's been a pleasure for us to have this opportunity throughout the week to think about each of the major asset classes, where we are now, and the opportunities, more importantly, that they offer to advisors and portfolio managers to put portfolios together. So to all of our presenters through this week, thank you very much. And we'll look forward to seeing you in person at Advice and Action, and to you joining us through our future webinars. Thanks very much.